Long-term care insurance is like a fine wine. The earlier you get it, the better the value and the more options you have. If you wait too long, you can't get it at all. I'm Mike Samet, a long-term care and life insurance practitioner. I'm sure you have all done a great job building up your net worth over the years, contributing to retirement account like a 401k, saving to eventually leave an inheritance to your loved ones. Long-term care insurance will protect what you've worked so hard creating all these years. I call it portfolio insurance or protecting the vault. It will not make you rich. It'll prevent you from becoming poor. Let me repeat that. Long-term care insurance will not make you rich. It'll prevent you from becoming poor. Now, I'm going to talk to you about something you probably won't need for several years, maybe 10, 20, 30 years down the road. Must be at least 35 to get a policy, and you can get up to age 80. And we can go up to age 87 for some of our annuity care type products. And if you're younger than 35, I'm sure you have parents 50, 60 year age range. Do you want to care for them, bathe them, dress them, feed them? If not, I suggest you forward this on to them. I know it's something we don't like to discuss, end of year activities. I just had the death conversation with my wife the other day. I told her I wanted to be cremated. She made an appointment for Tuesday. And we got an argument in an elevator. I was wrong on so many levels. All right, let's dive in, shall we? What we're going to discuss today is what is long-term care? It has several different names. I'm going to go over some facts and figures, impact on families, impact on finances. Long-term care is not inexpensive. And then we'll go over some examples. All right, what is long-term care? It's often referred to as custodial care, long-term care, or extended health care. All the same thing, just some different names for it. I know the first thing we think about is a nursing home, but it's much more than that. It's also home health care, adult daycare, facility care, informal care, and many more, such as residential care, adult foster care, and memory care. When do long-term care benefits kick in? When you cannot meet two of the six activities of daily living: bathing, eating, dressing, transferring, moving in and out of a bed, in and out of a chair, toileting, continence, or have a severe cognitive impairment. All right, this slide usually shocks folks. These are national averages. It's a little more expensive on the East Coast and the West Coast, depending on what part of the country you live. Adult daycare, it's going to run about $25,000 a year. Assisted living facility, about $74,000. Home health care, $80,000 a year, and that's for a 40-hour week. Once people need more than 40 hours of care, it's typically more cost effective to move into a facility. And to share a room with a perfect stranger in a nursing home, it's going to run about $115,000 a year. If you've done proper planning and can afford a private room, it's going to run about $130,000 a year. And that's just 1 year of care. Now, we're going to need care for more than 1 year, most likely. Average length of care for a male, 2.2 years. For all you females, 3.7 years. Average length for Alzheimer's, it's running 8 years. This company, AALTCI, did a study. They interviewed 7 of the large insurance companies to determine longest cases male, longest cases female. So we learned a few things from this study. Most likely that these people purchased a lifetime benefit versus 2 years, 4 years. Also, we assume they had a cognitive issue, Alzheimer's, dementia, Parkinson's. What really shocked me is gender really didn't matter when it comes to these long-term cases. In the previous slide, we saw 2.2 years for a male, 3.7 for the female. But here, 5 of the 7 longest cases happen to be males. Some trends we're noticing in the industry. 10,000 people a day are turning 78 in this country. Baby boomers born 46 to 1964 are becoming of age, needing care, not now, but very, very soon, and a big wave right behind them. So this is going to have a big impact in supply and demand. So the silver tsunami is coming. Medical technology's done wonders for our bodies, our minds, not so much. We're living much, much longer, but these cases of Alzheimer's, dementia, Parkinson's are on the rise, and we expect this trend to continue. Family dynamics have changed over the years. Kids and parents don't live in the same cities. Parents retiring down south, out of the cold, kids moving wherever for a job. Parents don't want their kids to put their lives on hold to care for them. All right, family dynamics have changed quite a bit. Parents and children typically do not live in the same town anymore. And most parents don't want their children putting their lives on hold to provide care. Government programs, what's available today might not be available tomorrow, but either way, we will not be depending on the government for anything important. All right, my last set of stats here, facts and figures. 70% of everyone listening to this will need care at some point. I know you think you're in the 30%, and I hope you are. And 20% of those needing care will need care for greater than 5 years. If you're a couple, husband and wife, the chance that one of the two of you will need care, 91% chance. Again, you might be in the 9%, you might be in the 30%, but what if you're not? I want to ask you 2 very important questions. If you do need care, how would it impact your family? Now, fast forward to age 90. How will it impact your loved ones? The impact on your spouse. How's it going to affect your spouse's plan? I don't want my wife to give up playing pickleball to care for my sorry self. She's already told me she's not going to wipe my 95-year-old ass. I'm like, well, that's fine. I'll just hire a hot 70-year-old to do it. Physical challenges, she can't pick me up now. Is she going to be able to pick me up as a frail 85-year-old? Financial impacts. Again, adding a bill to our life. How is that going to impact her financially? I don't want to do that to her, having her to reduce her lifestyle because I'm at a nursing home at $130,000 a year. Caregiving children. I don't want to be bathing my parents, and I certainly don't want my kids bathing me. It will scar them for life. I will not, I repeat, I will not be a burden on my kids. They have their own lives, jobs, families, careers, dreams. I would never ask them to give that up. Siblings, I've seen this firsthand. The fighting amongst siblings about who is on parent duty rips families apart. Tension, resentment. Do you all get along with your siblings and agree on everything? And if you're single and have no family nearby, you'll need a plan. What is it? Who will be designated to care for you? And are they willing and able to accept that responsibility? And the other big question I want to ask you, if you need care, how will you pay for it? Typically 3 ways: taxpayer assistance, Medicare, Medicaid. Well, Medicare is insurance, which will only pay for a very brief period of time following a hospital stay. Medicaid, you need to be impoverished for Medicaid to kick in. And then you're at the mercy of the government in a government facility. And I will not depend on the government for anything. Traditional long-term care insurance. I would applaud anyone to get insurance. Now, these old traditional policies aren't the greatest. They're raising premiums as the cost of care goes up. They're raising them to the point where people can't even afford them anymore. So they're lapsing the policy. And those traditional policies are a use it or lose it scenario. So if you don't need care, if you're in that 30% and don't need care, well, the money's gone. And then the third way is by default, just pay for it out of pocket. Personally, I am transferring risk to One America to pay for my care. Same thing I do with my health insurance. And I had a prostatectomy a few years ago. Ran about $100,000. Now I could have paid for it out of pocket. Would have had to have sold some assets, and I didn't want to do it. So I had Florida Blue pay for it. I transferred risk to them, and I only had to pay a few $1,000s out of pocket. Impact on finances. This is not a one-time payment. People could be on care 2 to 20 years. Just adding a new bill. So let's say a retired couple's living on $100,000 a year. One spouse needs to go into a facility, adding $100,000. Where's it going to come from? How are you going to fill that $100,000 gap? You're going to have to sell some assets. What will you sell first? This is a risk, selling at an inopportune time. Real estate, stocks, you're going to sell when they're depressed, or if you sell when they're high, you're going to have a tax liability. If you pull more money out of your retirement account to pay for care, bigger tax liabilities, which could affect your Medicare premiums. So it's a ripple effect. Long-term care is an income problem, not an asset problem. All right, here's how it works. Here's a typical portfolio. Conservative bucket, moderate, aggressive. So what we're going to do is we're going to carve a little piece, let's say out of the conservative bucket, to purchase care, long-term care insurance. So that little piece is going to buy a death benefit, a larger death benefit. Well, One America goes one step further. They're offering a lifetime benefit. So you're carving a little piece of the pie for a really big piece, tax-free. This is by far the biggest expense we face in our final years. So we're carving out this one little piece to protect the whole pie. This is portfolio insurance. It's retirement lifestyle. It's everything insurance. And it's not just for old people. It comes into play with cancer, car accidents, strokes. This could happen at any time. All right, if you haven't been paying attention so far, this is part you might want to stop multitasking and listening. This diagram explains how the concept works. I think we all understand what happens when we die. Beneficiaries get a larger death benefit. But if you need care, this is how it works. So here's a timeline. Let's say you go on care. You're going to use up the insurance part, the life insurance part. And once that's exhausted, that's when the long-term care rider kicks in, which will pay for care as long as you live and need care. You could be on care for 100 years. One America will pay for it. Again, it will not make you rich. It's designed to keep you from becoming poor. Wealthy folks have figured out how to not give money back. I don't know any truly wealthy people that don't have long-term care insurance. Wealthy people understand the tax code and how to minimize tax liability. This is all tax-free money paying for care, and they understand leverage, turning pennies into dollars, putting in $1 and getting $15 in the future to pay for your care tax-free. All right, we'll run through a few examples. We can stack policies, getting multiple long-term care policies. We can pay for it from income, savings, or even with qualified money. Stacking strategy. A lot of people look at all the life insurance day one that they're going to need. As their income goes up, they get additional policies. Similar strategy with long-term care. So here's an example of a young 40-year-old couple. $1,300 a year, a little over $100 a month, getting them $24,000 a year in benefit each. Again, previous slides, probably not going to pay for a nursing home, but it's a really, really good start. And $50,000 of benefit of death benefit if they don't need care. Let's say 5 years go by, got a kid out of college, they can free up another $1,600 a year for policy number two. Same benefit, same death benefit, same long-term care benefit. Just cost a little bit more. Again, costs go up as we get older. Let's say we do this every 5 years. Well, by now we have a pretty darn good policy combining the three of them. $96,000 benefit for the female, 96 for the male, $200,000 death benefit. Again, that's not why we're doing it. Another way to pay is just pull money out of the savings. Again, it can be done monthly, quarterly, semi-annually, or annually. Here we're carving out $10,000 for nearly $169,000 of death benefit. But here is really where the magic is. You put in $10,000 a year, you're going to get $84,000 a year in benefit for the husband, and the same for the spouse. A total of almost $169,000. That's turning pennies into dollars. Third way is to repurpose some qualified money. So let's just say this is your IRA. Let's pull out $150,000 of it. Well, what OneAmerica will do is they're going to give you a 25% bonus, or $37,500. So now you have a total of $187,500 going into an annuity that will buy long-term care over a 10-year period at $18,750 a year. Now, this money has not been taxed before, so you will have to pay tax on the $18,750, but we're spreading that over a 10-year period, so it's not going to bump you up into a higher tax bracket. So here's what that would look like. You're injecting $150, you're getting $166,000 of death benefit for a long-term care benefit of $83,000 a year, husband, $83,000 wife, for life. The power of long-term care income insurance. You're only one choice away from changing your life and for those you love. Is there a plan in place? Now remember those two questions I asked you. How will it impact your family and those you love? And how will you pay for it? Love this quote by Warren. If poor people would do what rich people do, they wouldn't be poor anymore. All right, before I sign off, I just want to let you know the reasons my wife and I got a OneAmerica asset care policy. We didn't want to be a burden on each other. We didn't want to be a burden on our kids or future grandkids. We didn't want to pay for it. We wanted to transfer risk to OneAmerica. We didn't want to drain our estate. That money is earmarked for our kids and grandkids. We love the fact that we can turn $1 into $15 tax-free. OneAmerica really has an amazing plan. They can never raise premiums. It's written about 6 places in the contract. If either my wife and I go on care, premiums are waived. They would resume again if we come off of care, but that typically does not happen. Once one goes on care, they typically don't come off. And if neither of us need care, if we're in that 9%, our kids will get a death benefit. So it's not a use it or lose it scenario. Also, OneAmerica pays all the claims in-house. They don't outsource to a company that doesn't care. So based on the statistics we have, with the 91% probability that my wife and I will need care, we felt this was the right move for us. Let me know if I could be of further assistance. Here's my contact information. And thank you for listening.